Welcome, ladies and gentlemen, to our next video. In this video, we're going to go over exactly what banks are next to go. We're also going to go over some things that is happening with China's shadow banking industry. The situation is just getting worse. Then I'm also going to cover the potential 2024 housing market crash. First, I'm going to cover the US, and for my Australian viewers that are wanting an update on the Australian housing market, I'll then get into a little bit update on the Australian housing market as well, because things are getting absolutely insane. So everyone, we have a lot to cover today. We've got a lot of news, facts, and data. So you know what time it is. Let's get straight into it. So first things first, look at this. These regional banks are at the greatest risk of being taken over by rivals, according to the KBW. This is who do the regional banking index on the stock market. Now, what could happen is we could see hundreds, if not thousands, of smaller banks taken over by the big mega banks like JP Morgan Chase, like the BlackRocks of the world. So that way you only have a few choices of who to bank with. And this will work great if they wanted to implement something like a social credit score or central bank digital currency, because right now you've got thousands of choices. But if they continue to take out a lot of these smaller players, that will give you less and less choice of where to go. So which banks are they talking about are most at risk? Well, let's go ahead and adjust this here. Well, they're saying Commercia, Zions, and First Horizon might ultimately be acquired by more profitable competitors, according to KBW. And that's because these banks are pretty much on the brink of failure. Larger banks with strong returns, including Huntington, Fifth Third, M&T, and Regions Financial, are poised to grow through taking over small lenders. Two other lenders, Western Alliance and Webster Financial, could also consider selling themselves, KBW analysts said. And these are two banks that have, been under a lot of pressure lately, and they're facing more and more issues that could spread if we see lots of small banks into some of the larger banks. So let's go ahead and dive a bit deep into this report. So while others were more bullish, KBW analysts downgraded the US banking industry in late 2022, months before the regional banking crisis. So there were warning signs there that things weren't looking good. KBW is also known for helping determine the composition of indexes that track the banking industry. Banks are waiting for clarity on regulation and interest rates before they'll pursue deals, but consolidation has been a consistent theme for the industry, they said. So these are the banks to watch for who may be next to fail or who may be brought out at the last minute, like what we're seeing with some other banks to save them. Because also the same thing is happening in China with their shadow banking industry. Look at this. China scrambles to contain a looming shadow bank meltdown. This is what I talked about yesterday, and we've got more proof and data that it is getting worse. So investors have protested against Zongxi, which has missed payments on some of its products. But we've got more economic data from China that industrial profit growth is, as they have a deflationary problem. And the only way you get deflation is with a really deep recession. But according to the China's GDP they're putting out, their economy is booming. Well, you can't trust the data. You have to follow the money, everyone, which I'll show you another report in a moment. So profits rise 2.7% year over year in October, slower than the September gain, and other data for the last 6 months is mixed as recovery remains fragile. But look at this next story, everyone. China bank backed dollar bond sales plunge amid default jitters. And look at this. Look how much they've plunged by. Dollar bond sales with standby letters of credit slump 90%, and lenders are reluctant to provide pledges as defaults mount. So according to China, their economy is booming, but if you follow the money, a lot of offshore investors, they're not getting paid on their bonds and they're fleeing in droves. So with the nation's developers going through a fresh round of crises, even larger builders defaulting, banks are reluctant to provide such pledges. Investors also have doubts over the structure, which falls short of being an explicit repayment guarantee. That's upended a market that helped lower rated companies, including local government financing vehicles, raise a record $10 billion in 2022. And look at this, sales plunge. We can see issuance of China dollar bonds with bank guarantees, they're fallen off a cliff. So we have big issues with the US banking industry, and also big issues happening in China. But now I want to talk about the housing market, because the housing market has been very resilient. It shocked a lot of mainstream analysts. Even they thought there would be a big correction, and there has been in many areas. And remember, I'm speaking about the US housing market as a whole. Every city, every suburb has their own market and will perform differently. But look at this news we just got out. Roughly 54,000 US home purchases were cancelled in October as buyers backed out of deals due to sticker shock, or when sellers didn't meet their requests. The cancellation rate could tick down this month as buyers take advantage of the decline in mortgage rates, but we'll have to wait to see if we get that data. So look at this chart here. We can see now this has reached a new high of cancellations, 17.2%. And if I was a buyer, I would be canceling as well, because look at this. In some areas, it's now 52% more expensive to buy the rent in this housing market, and shoppers are pulling out of contract offers left and right. That's exactly right. If you're an investor or a homeowner, there's lots of areas right now where it is much, much more cheaper to rent than buy. And this math cannot continue to go on. I was looking at some investment properties, and they were around $500,000. And for these investment properties that are around $500,000, you were looking at negative cash flow of $1,500 a month. And I just took one look at that and said, no way, this does not make sense at all. We need to see a minimum 20% correction for deals to start even looking slightly enticing again. This math of it being 50% more expensive to buy than rent simply means a big correction has to happen. And I've got more news for investors pulling out that I'll show you in a moment. So in fact, it's cheaper to rent than buy in nearly every major market in the US, with Wall Street Journal reporting that high mortgage rates make buying 52% more expensive on average than renting in this climate. Median rents have been dropping across the country. That's happening in the US and Australia. They're absolutely skyrocketing still, which is crazy. We'll get into that in a moment. Improving affordability for tenants and helping them rethink their desire to enter the housing market at this profoundly pricey time. And home buyers, look at this. Look how much you have to be earning just to afford the average US home. Not a luxurious home, just the average. You have to be making $114,000 a year to avoid the median price US home, according to a separate Redfin analysis. And just on top of that, insurance premiums are skyrocketing as well. So ever increasing insurance premiums and disagreements on who's responsible for needed repairs behind the cancellation rate. Heather said at Redfin, premier agent in Jacksonville, given the astronomical prices, home buyers are being more cautious. She said, buyers hold a lot of the cards right now, and sellers are having to give out more concessions to close the deal. And just again, I forgot to do this at the start, but just type 1 if my mic is working well. Because look at this next story, everyone. I'll go ahead and adjust this here. Investor home purchases fall a record 49% year over year in the first quarter. Like I was saying when I was doing my due diligence on those investment properties, it doesn't make sense to be an investor right now. You're getting massive negative cash flow. You're buying something that is losing you money. If you buy something that loses you money, it is not an investment. Because people may say, well, look, it's going to appreciate. Well, I don't think there's going to be much appreciation when there's interest rates are at such high levels and house prices are at the most unaffordable levels they've been in history. It's simply in bubble territory, and a huge correction in 2024 is going to happen, I think. Because look at this. What have they been saying the reason why the housing market won't crash is because inventory. And that's true. We need inventory to tick up, which is now happening for there to be a correction. So look at this latest data. Housing inventory gets largest month-over-month boost in more than a year. So RE/MAX reports that the number of homes on the market grew month over month for a 6th consecutive month in September, and I've also got updated data for October as well. As sales declined 13.8% from August and 17% from a year ago. There's also been a 9.3% increase in inventory, and that was the largest month-over-month increase in 14 months. So even so, inventory is 8.6% below the September 2022 levels. But I'll bring up a chart here. I'll go ahead and adjust this and move myself so you can see. We can see inventory bottomed around February 2022. That's when house prices were still going up, but we are starting to see a reversal. Inventory is picking up. And if property taxes keep going up, if insurance keeps going up, you may see a lot of boomers that are going into retirement. They may have a lot of equity in their home. The cost of living is putting a big squeeze on them. They may be forced to sell, and this could make inventory go up. Like I showed you in yesterday's video, we're seeing foreclosures rising. And look at this next chart. Delinquency rate of multifamily housing. So this is a Freddie Mac serious delinquency rates for multifamily. It is absolutely skyrocketing. Now remember, they put a pause on this in 2021 and 2022 because of the pandemic, but we can see now this trend is reversing. So once we get inventory pick up, we will get that correction we're all waiting for. But for some of those of you around the world wondering how bad can this bubble get? Can it get even worse? What is the worst housing market bubble in the world? Well, guess what, Australia? We've won the trophy for the world's worst housing crisis. That's right. Worse than New Zealand, worse than Canada, worse than the US. This is how bad the bubble can get. So housing, a vicious spiral, drags Australia into a deepening crisis. So it's getting harder and harder than ever to rent a home in Australia as one of the world's most acute real estate shortages worsen by the day. Now, just look at this. This is the vacancy rate. Australia has the lowest rental availability among its peers, and I'll show you house prices in a moment. Look at this. Singapore has 6.3%. The US has 6.3%. Again, this is the averages. Some areas may be worse than others. Hong Kong, 4.4%. England, even Canada, that has a bad housing crisis, but us, Australia, the lucky country, we beat you guys, unfortunately. And look at this next chart here of world's most unaffordable. And this is how bad the bubble can get. So Sydney homes are the world's second largest affordable, only to Hong Kong. But Hong Kong's a tiny island with no land. So I don't think you can really compare that. But, you know, Vancouver, which is known to have very expensive housing, beat that. It is now, you now need 13.3 years of income to pay for an average home in Sydney. That's compared to Vancouver, 12 times income, Honolulu, 11.8, San Jose, 11.5, Los Angeles, that's right, even more expensive than Los Angeles on average, 11, Auckland, 10.8, San Francisco 10.7, and Toronto 9.5. So Australia's housing bubble is now pretty much the world's worst besides Hong Kong. And unfortunately, what's going on now, the RBA is doing more interest rate hikes. So a lot of people that were going in there and buying these homes speculating that interest rates will be cut next year, well, Australia made a huge mistake. They were very slow to lift interest rates. Just only a couple of months ago, our interest rate was still just 4.1%, where every other major central bank was above 5%, like the Federal Reserve around 5.5%, the New Zealand Central Bank, Canadian Central Bank, the Bank of England, they were all above 5%. Australia tried to play a game of let's just try to see if inflation goes away on its own, and now we have a much worse inflation crisis, a much worse housing crisis, and now they're going to have to keep on lifting interest rates when other central banks are pausing for the moment. So everyone, again, these are the banks that are most at risk right now. Commercia, Zions, First Horizon will ultimately be acquired by more profitable competitors. China's shadow banking industry is in meltdown. Their dollar bonds are collapsing 90%, and it's looking very, very bad for the housing market. So everyone, what do you think about this? What do you think is going to happen to the housing market in 2024? What banks do you think are the next to go? Thanks for watching. You're awesome. I'll see you all in the next video.